Welcome back, guys. Welcome back, traders. I'm really excited about this lesson because we are moving into one of the most powerful ways to read the market, which is price action and market structure. And I'm really excited that you guys have also reached this far. We've learnt about lesson one, lesson two, and now we are moving into one of the juicier aspects of forex trading, which is lesson three, and the topic is price action mastery and market structure. You see, a lot of traders rely heavily on indicators, but the truth is indicators actually lag. They only react after price has already moved. But when you understand price action and structure, you are ready to read the raw language of the market. So today I'm going to be walking you through candlestick patterns, how to read price without any indicators at all, the phases of the market, continuation versus reversal signals, swing highs and swing lows, and finally, how to use multi-time frame analysis for confirmation. And by the end of this lesson, you should be able to open your chart, even a naked chart, and understand what's going on. And because of the people that I might be using mobile, I'm going to be using mobile for our demonstration, both mobile and both laptop for our demonstration. So now let's start with candlesticks. Now, what is a candlestick? A candlestick has four main parts: the open, the close, the high, and the low. And there are two types of candlestick: a bearish candlestick and a bullish candlestick. Most of the times, a bearish candlestick is always red on the charts, and a bullish candlestick is always green on the charts. Let me show you an example of how candlesticks look like. So on the mobile, you can see that this is how candlesticks look like. As you can see. So let me go to the daily time frame. So as you can see this blue. This blue represents the green now, the bullish candlestick, and this one represents the red, bearish candlesticks. So now, as you can see how I've labeled on the screen, this is the low, this is the high, and this thin line is called a wick. This thin line, as you can see, as I've labeled, is called a wick. And then the thick part is the body. It's called the body. Now, a bearish candlestick opens right about this spot and then closes right about the spot. Meaning, when it's formed, then the market pulled back to form this wick, to form the low of this candle, the low of this candle. Do you understand? To form the low of this candle, then went up to form the wick. This is the high. Sorry, I made a mistake in the label. This is wrong. This is the high, this is the low. I mixed it, I'm sorry. So now, as you can see, price when price started forming on depending on the time frame, then price formed a wick here, then it pulled back, then came back up, forming the high, then pulled back. closing off here, then forms like that, forms like that. Let me show you how it forms. Let me show you a 1 minute example. Now this is how a 1 minute example is going to look like on your MetaTrader 5. You should see something like this. So as you can see, price has formed the week. So price is still moving. Okay, for this last candle, this is the high, this is the low, this is a bearish candle, meaning it's opened here and closed here. But this is a bullish candle, meaning it's opened here and closed here. So you can see a bullish candle is going up, a bearish candle is going down. As you can see, it's opened here, it's opened here. So if it closes up, it's going to be a bullish candle. But if it closes down, it's going to be a bearish candle. It probably wants to form the wick and then continue down. Do you understand the analogy? If you don't understand, just keep checking how the chart works. Just keep checking it. Just keep checking it. You see that it starts to click in your mind. Now it's forming the wick. It's forming the wick. So now this is the high now. This is the high. Let's wait till this candle finish forming. Still forming. Okay. It's still forming. Okay, few seconds. 4, 3, 2, 1. So as you can see, now this one is interesting because it didn't have an upper wick. You can see, so it has different formations. It has different formations. It had a low, it had a tiny wick, then a large body. Now, this large body tells us that the market's momentum is, it has a lot of momentum. You understand what I'm trying to say? It means that the market has a lot of momentum. So we've seen in that live example, you can see how a candlestick forms. So now, like I said, a candlestick has four main parts: the open, the close, the high, and the low. That's it. So if price closes higher than it's opened, you see a bullish candle, usually green. And if it closes lower than it's opened, you see a bearish candle, usually red. So now, why are candlestick important? That's because they show us the battle between the buyers and the sellers within a specific time frame. As as we've seen in this example now, as you can see, the buyers in this candlestick that we saw when it was forming, you can see that the buyers had more pressure than the sellers. So as you can see, this candlestick now, the sellers are having more pressure than the buyers. So it just shows us how you know how the buyers or the sellers are strong, which one is more stronger and which one is less stronger within a specific time frame. So now let's look at some key candlestick patterns. Now, this example that I've seen here is a that you have seen on the screen is called a doji candlestick. Now, this doji candlestick shows what we call indecision, meaning there's no decision, meaning there's no buying pressure, there's no selling pressure. So as you can see, the open and the close, they are almost the same. Look at it, they are almost the same, just like as if the open and the close was on that same price. As you can see, as you can see. So meaning neither buyers nor sellers were strong. So when you see a doji candlestick after a very, very deep trend, it's often a sign of reversal, meaning the market is tired. So it means maybe the trend is already like reducing, the movement is reducing, or there's about to be a reversal. As you can see, there's what we call a dragonfly, a gravestone, a long legged, and so on and so forth. But we know that this is a bullish doji and a bearish doji because of the candle color. We also have engulfing candle. Now, this one is one of my favorites. A bullish engulfing meaning the buyers completely wiped out the sellers from the previous candle. Let me show you an example of a bullish engulfing. Let's assume we had a bearish candle now. Don't mind my joint. Then we had a bullish that completely covered the whole body of this, bearish candlestick. It completely covered the whole body. That's what we call a bullish engulfing candlestick. So bullish engulfing candlestick usually gives some traders like confirmation to enter the market either at a reversal or whatever they want to call it. So now, like I said, engulfing candlesticks are powerful reversal signs. So, and there's a bearish um engulfing candle as well. So let's assume price was bullish, and then we had a bearish candlestick. Sorry, don't mind my drawing. Then we had a bearish candlestick. So this is a bearish engulfing candle. So we also have the hammer or pin bar. So imagine a candle with a long wick and a small body. This shows rejection. So we call them rejection candlesticks. Let me see if I can find an example on the live charts. So as you can see rejection candlesticks here. You can see them, meaning price is rejecting. So you can see this is also a very strong sign that um the market is about to reverse. When you see rejections like this, when you see rejection candlesticks, there's also for buys as well. Let me see if I can find example for buys. As you can see, rejection candlesticks, meaning the market wants to, reverse. So anytime you also see rejection candlestick is a sign of either an entry or a reversal. You understand? So now let's pause and analyze a real chart together. Open your chart and then try to figure out the engulfing candlesticks. Try to figure out the engulfing candlesticks in the charts. So as you can see on the screen, try to figure out the engulfing candlesticks. Let me show you an example. This is Let me draw it out. This is a bullish engulfing candlestick. So just try to check. You can see these are rejection zones. Let me draw it out. These are rejection zones, meaning the market is about to reverse. So probably this, as you can see, there's a form of when we reach there, I'll tell you what that means. So as you can see, that was a rejection, meaning the market is about to reverse. And what did it do? It actually reversed. So just try to, analyze the chart and just try to, try to see it, try to be able to see it, because once you are able to see them properly, then there won't be a problem for you anymore. So now that's that. about candlestick patterns. So now it's time to read the market. So now there are two types of, you know, price action. There's the bullish price action and the bearish market or price action. So now the bullish market is the type of market that forms higher highs and higher lows. Let me write that down. Higher highs and higher lows. And then a bearish market forms lower highs and lower lows. So now these are what we are going to be using to determine the direction of the market. Are we going to buy or are we going to sell? So these are the basic of market structure, of reading the market without any kind of indicator, without any form of indicator. Now we are going to be trying to read the market on our trading view. Like I said, make sure you have trading view downloaded. So now, before we try to read the market, let me just show you an outline of how market structure looks like. Now, this is a basic line example of how market structure look like. Obviously, it's going to be more complex than this. It's going to be, just too complex, but once you already know how to read proper market structure, it won't be a problem for you. But the basic that you need to know now is that this is a bullish market structure and this is a bearish market structure, also a bullish trend and a bearish trend. We have three types of trend: a bullish trend, a bearish trend, and a ranging market, which is also known as consolidation. So that's when price is just moving in a range on support and resistance. We are going to be talking about those other deeper topics in later lessons, but you just need to know that there are three types of market trend: a bullish market structure, a bearish market structure, and a consolidating market structure. Now, this is where in some strategies, this is some of like the basics of how people are going to find their entry, but don't let me go into that. But what you need to know about market structure. So now for a bullish trend, like I said, price forms higher highs and higher lows. Now for the higher low to be valid, price needs to break structure. So price needs to break this higher high right here. So once price breaks this higher high with a body, note with a body, not a wick, with a body. Once price breaks this higher high, this higher low and this higher high is valid. So now we are officially in a bullish market structure, in a bullish trend. So once price breaks the higher low, the higher high rather, once price breaks the higher high, we are officially in a bullish market structure. So now, where do we want to enter the market? We can't just enter the market from here because obviously the market is going to want to reverse, forming another higher low, then breaking that higher high, making sure this higher low is valid, breaking it, then forming another higher low, depending on how the market is going to hold, then pushes up again, then forming another higher high, forming another higher low. Now, what do we call this? This is what we call a break of structure. A break of structure. A break of structure. We also call it break in market structure. Break in market structure. BMS or BOS. A break in market structure. So now, price has reached this level. It has probably overbought if you should check probably an RSI indicator, relative strength index, you can see that probably the strength has already overbought. So meaning the market wants to start reversing, or you're already seeing rejection candlesticks up and down, or is reacting to a particular supply or demand, a supply zone. So meaning the market wants to start reversing. So if the price is still price hasn't broken if price hasn't broken this higher low here, we are still in a bullish trend. But if price has broken the higher low, then we have officially entered a bearish trend. So now this is what we call a change of character. A change of character. Meaning price has changed its course. It's no more bullish, it's now bearish. So we can call it a change of character. We can also call it a flip zone. A flip zone, meaning price has flipped away from bullish to bearish. So now this is officially a lower high, and this is now a lower low. Do you understand it now? So the same analogy for a bullish market structure, the same concept. So if price breaks structure here, forming a lower high, a lower low, and continues like that till you understand it like that. So majorly we want to be looking at higher time frames, meaning from the 1 hour, 4 hour, 2 hour, depending on your strategy, 4 hour, daily time frame, or probably 8 hours. The time frame I usually use on gold is 1 hour time frame, but for other pairs, I usually use the 4 hour time frame. And you can use the daily time frame to check the overall market direction. For example, the overall market direction on gold is bullish on the daily time frame. On the 1 hour time frame, it's bearish, I think. So that's that about the um bullish and bearish market structure. I hope you understand this now. So let's go to the chart and let's try to analyze markets. So like I said, we are going to use the 1 hour time frame. So as you can see, let me just squeeze this. So as you can see, price is currently in a bearish market structure. You can see that price broke structure here, then did it reversed, then it's pulled back. So we call this phase a pullback. I forgot to mention it, sorry. Or a retracement. We call this phase when price like comes back, like probably sell maybe a minor it makes a minor, sell structure. We call it a pullback or a retracement. So for example, we have like some complex market structure. Market structure can be like this, then it can be like this, then it's just like too complex, and then you get what I'm trying to say. So it's complex. It's not just line like this, like I'm drawing. This one is just like for you to understand the concept. But if you want to try to grab it better, you can also use the line chart. So as you can see on the line chart, it's kind of much more clearer. As you can see now, price is currently in a pullback phase. You can see price broke structure here and pulled back to this level, and now it's probably trying to continue in the direction, as you can see now. So this is how market structure looks like. So I usually also use the 15 minutes time frame just to check the internal market structure. Also the 5 minutes time frame as well. You want to be using the 1 minute if you are trying to scalp the market. So as you can see, price has been having bearish momentum. Then I had just a quick buy here, then a sell entry here, then two sell entries here. So now, but today I've not seen any kind of opportunity because the market is still consolidating parts. But as you can see, the market is just consolidating. So it's not having any clear movement. But as you can see, price made a massive movement up here, then drop down, then it's still consolidating. So until is either price probably push up, then I find a buy entry when price comes back, or price just push down, then I find a sell entry when price comes back. So that's that about that. And I also explained consolidation. Consolidation is when the market is just ranging. So you can just like spot, for example, now this is a consolidation. So it's not compulsory, it's just like WW, but you understand how like this is like a consolidation channel of sorts. So you can see this is a massive trending movement. You can see this is a massive trending movement as well. And this is another example of consolidation. Price came here, it came down, came here, it came down, it came here, it came down, it came here, it came down, it came here again before breaking structure to the upside. So you can see that. Then on this last week Friday as well, price was just consolidating up and down, up and down, up and down, up and down before breaking and then coming back, then going again, then coming back and going again. It started consolidating again. Like once you are able to master this thing, you'll be able to see pure price action. You don't need to use any indicator of sort, but I like using indicator to show, the minor market trend because if of I'm day trading, I'm not a swing trader or a star, I'm a day trader. So that's that about that. So now, when you are reading the market, you need to ask yourself three questions. Is the market trending or is the market ranging? And if the market is trending, it means you want to be looking for a possible entry in that market direction. And if the market is ranging, it means you want to wait for a breakout. Though there are some strategies that you can be able to, trade in a ranging market, like a support and resistance um strategy can be able to use it to quick scalp in a ranging market. But on a norms, you just want to ask yourself, is the market trending or is it ranging? If it's trending, then like I said, you want to look for a possible entry. If it's ranging, then you don't want to be trading during a consolidation. Then another question you want to ask yourself is where are the higher highs and higher lows or lower highs and lower lows? So you want to be able to understand structure, like I just explained. Then where is price rejecting or respecting certain levels? So for example, if price is making higher highs and higher lows, that's an uptrend. If it's making lower highs and lower lows, that's a downtrend. And if it's just moving sideways, that's a range. So this is why you don't need indicators because price itself is going to tell you everything you need to know and how to read it. So now the next topic I want to be talking about is the AMD, which is accumulation, manipulation, and distribution. Now this is very, very important. This is very, very important. So now the accumulation phase is also the consolidating phase. And then the manipulation phase is when markets, sweeps out the highs and the lows of the range. So if price manipulates ups and sweep all these, equal highs and equal lows, that's manipulation. If it's down, that's also manipulation. Then distribution phase is when markets now, after manipulating, then it's now changed direction to its original direction because this is just a manipulation. This could also be for so price goes down, goes up. You understand the logic. So let me show you an example on the charts. Translate, for example. Okay, let me use this example. Accumulation, then manipulation, then distribution. Can you see it? Price accumulated was just ranging, then it manipulated all the ranges, as you can see, then it's now finally distributed. Some people would have found, I would have found like an entry, tiny entry here, or depending on, like I said, depending on your strategy. So that's that about that. So now, like I said, market moves in phases. So the smart money guys, they leave clues, and that is when where this accumulation, manipulation, and distribution comes in. Accumulation is where the big players they are quietly building their position, and price often ranges here. It looks boring, but smart traders are loading up. Smart traders they are waiting patiently for the market to manipulate, then give a clear direction. Then manipulation. This is when the market fakes out retail traders. It looks like it's it looks like it's breaking one way, but then snapbacks. That's what we call a stop hunt. So and stop hunts are usually above equal highs and equal lows, or where liquidity is drawn to. Then distribution. This is where the trend actually runs to. The big move, and this is where traders who entered early make their profits. So you don't want to be entering during this, and you don't want to be entering during the manipulation phase. You want to wait for the accumulation and the manipulation phase to happen before you find your distribution phase. And most of the time, distribution phase is always during New York session. Manipulation is always during London, and accumulation most times during Asian session. Though it can vary, but most times the distribution phase is usually in the New York session. That's why I like trading the New York session. And once you are able to understand these phases, it will help you avoid being trapped like most retail traders. I don't want to be really teaching you some stupid double bottom, double top, but it can actually help you in some, in some stuffs. But let's just see. So now we are going to be talking about continuation versus reversal signals. So sometimes the market just keeps going, other times it reverses. And how do we know the difference? Through continuation patterns like flags, pennants, and simple pullbacks. And if price trends, then it pulls back slightly and continues. That's continuation. But reversal signals like double tops, double bottoms, head and shoulders, engulfing candles at key level, and so on and so forth. So here's the trick. Context matters. A reversal pattern in the middle of nowhere is weak, but the same pattern at a strong level can be good. That's just it. So I'm going to be attaching a little resource with this video for you to be able to know the continuation pattern and the reversal signals properly. You can also search on the internet. There are many resources available for it. Now let's talk about swing highs and swing lows. Now this is a very, very important thing to know because it's also part of market structure. Now a swing high is the peak between two lows, and a swing low is the dip between two highs. For example, this is an high, this is an high, this is the peak. This is a low, this is a low, this is the peak. Do you get it? And the dip between two highs, this is an high, this is an high, this is the peak. So this is a swing low. And to make sure the swing low is valid, that's why I drew this candlestick. The candlestick the of that low must be, you know, this one should not be like this, the wick should not be like this. If not, this is swing low and not this, like I said. So this is how to, find a valid swing structure. So let me show you an example on the charts. For example, this is a swing high. This particular higher high is a swing high. This is a swing low. This particular lower low is a swing low. Do you get it now? So yeah, that's that. So now when price breaks a swing high in an uptrend, like I said, that's called the break of structure, and it confirms that the trend continues. But when price breaks from higher highs to lower lows, that's called a change of character. And like I said, is a trend reversal signal. So now, multi-time frame analysis. We have higher time frames, medium time frames, and lower time frame. Now, this multi-time frame analysis is where everything comes together. If you only look at one time frame, you will often be tricked. A market might look like it might be bullish on the 15 minutes time frame, but bearish on the 4 hours. So what do we do? Multi-time frame analysis. Now, this is the rule of thumb. Use higher time frame, which is usually the weekly time frame, the monthly, the yearly, but that's if you're a swing trader. The weekly, the daily, the 4 hour, and probably the 2 hour. Then the mid time frame, which is the 1 hour, and then the low time frame, 1 minute, 3 minutes, 5 minutes, 15 minutes. This 15 minutes could also be in this part, and this 1 hour could also be here. So now we use higher time frame for direction, for the direction of the market. We use the medium time frame for structure, for market structure, to mark out the market structure. Like I said, I prefer using the 1 hour. And then we use the lower time frame for entries. So we use the lower time frames for entries. So if you are scalping, you use 1 minute, 3 minutes. If you are day trading, you use 5 minutes, 15 minutes. And if you are maybe a swing trader or a position trader, probably that's when you start using the 1 hour, the 4 hours. Also 30 minutes as well for structure. Yeah. 30 minutes, 15 minutes, 1 hour. Then for lower time frame, 15 minutes, 5 minutes, 3 minutes, and 1 minute. You can also see 2 minutes, but 2 minutes is rare. But 1 minute, 5 minutes, 15 minutes, yeah, that one is popular. So 1 minute if you are scalping, 1 minute and 3 minutes if you are scalping, 5 minutes and 15 if you are day trading. And if you are swing trading, 1 hour, 4 hours, and so on and so forth. So, for example, if the daily chart is bullish and the 1 hour chart is showing break of structure with higher highs and higher lows, then wait for a pullback on the 15 minutes and then enter the market. As simple as that. This alignment gives you the highest probability setups. Though probably in later modules, I'm going to be talking about my entry and exit strategy. So all right, we've already covered candlestick anatomy, reading price without indicators, the phases of the market, continuation versus reversal signals, swing high, swing lows with break of structure, change of character, multi-time frame analysis. Now, this is a lot to take in, so I encourage you that you should go back, watch this lesson again, and practice on your own charts. And in the next lesson, we'll take this deeper and actually start applying these concepts into real setups. Now, remember, the charts are your teacher. The more time you spend studying them, the more fluent you become in the language of price. Peace.